Today, folks, holy crud. I mean, at least that's what you're going to see in all these clickbait titles. Is even the Oracle of Omaha could have predicted this damn sell-off for the last 5 years. I don't know why, but everything sells off into October, followed by the Santa Claus rally into the holiday season. Yet here we sit with the Qs down 2.7%, continuing to sell off. Now, giving up so many of those gains, underperforming the S&P 500. And this is something I've largely predicted, telling you guys, I think the lower half of the market has been largely undervalued and is now starting to get lifted as tech is starting to correct, because tech, for the most part, still relatively expensive, but we're starting to get back into some value territory, as we're going to take a look at in this video. But just trying to decipher why. Like, why in September do stocks always damn well sell off? And I mean, I'm reading these articles. The stock market today, the NASDAQ leads losses by a mixed jobs report. Heaven forbid the U.S. added 142,000 jobs in August, which was a pickup from July, but not as many jobs as economists expected. So sell the stock market, baby. We're heading for a recession because the market always follows recession data. Sorry, I hope that made sense. But the market always bottoms before a recession is even damn well announced, and it's well on its way to recovery by the time you even know it's happening, for crying out loud, based on historic data that has no representation into the future at all. So what's happening here? Like, really? I mean, honestly, I've been reading things like this, like why September effects, or why the September effect could really exist. It's generally believed that investors return from summer vacation in September are ready to lock in gains as well as tax losses before the end of the year. There is also a belief that individual investors liquidate stocks going into September to offset schooling costs for children. Well, no one's having kids anymore. Is that still true? I don't know, but then you're going to read down here in these articles, oh, the jobs report, that has everything to do with the sell. It doesn't, it has nothing to do with it at all. So I'm very perplexed as we review my over $300,000 Canadian stock portfolio today with my leveraged bets, how I feel moving forward and the insanity of it all. And if that is a conversation you'd appreciate on your path to financial independence to damn well retire early, consider hitting that like button, subscribe while you're down there, baby, because if you go look at the market, like I said, go back to every frigging October period, that's where the market bottoms. I mean, it goes to 2021. I mean, you look at even 2020 to 2021 to 2022. Anytime you get into September, October, the market seems to find a bottom every year. It's so weird. It's so crazy to me. And when I'm scrolling through my watch list today, like, you'd think you'd be losing your marbles, and most of these people are, because they're degenerate gamblers that all they do is throw YOLOing options bets on a lot of individual volatility on things like Tesla and, you know, probably the Qs and stuff like that. Whereas I'm just sitting tight. I'm not freaking out. This hasn't been enough of a sell-off. This is not exciting to me, folks. I mean, get real. I mean, look at the last 6 months here. The market's down 4%. Ooh, you know what time I get excited is when we see a 10% plus sell-off, and I don't think we're going to see it. You know, time will tell. It'll be neat to see if we actually bottom out in October. This sell-off was pretty interesting when we got down to an 8% drop. But I told you just get a little bit of an emergency fund for when the market tanks. And when it tanks, you just double up your monthly contributions. And then when you start skyrocketing again, you just go back to your regular monthly contributions. It's like the easiest way to get rich. Easiest, hands down, with very little risk outside of like broad market, you know, risks of black swan events or whatever with the S&P 500. But I mean, when I'm looking at these stocks here, like, it's crazy. Like, you can get lost in this stuff. Like a squirrel without a nut, man. Tesla's down 8% today. Tesla doesn't become attractive to me until we get back into the mid 100s. Do we ever get there? I don't know. Google's getting hit. We'll talk about Google in a second because it's got some risk behind it that I think is also leading to an over excessive sell-off. Meta, I still think probably one of the better, you know, marketing or, you know, ads companies out there. But I'm really still just looking at my broad-based ETFs in my portfolio, right? Like, you know, we're still over 300K. You know, I most of my money is in these very low volatility things like SCHD and XLU. And I've been recently just putting a few $1,000s. I got like $3,300 that's triple leveraged into the real estate market, you know, with anticipations of what's going to happen when rate cuts come into play here. And I feel like this is my boring portfolio. It's just like there's nothing exciting here. But the fun thing about it is I get a lot of perpetual gains. Like, things have been going up very nicely, and when things sell off, they don't sell off a lot in my portfolio. Like, I have less volatility and still great growth. I mean, that's what every investor really wants, is to reduce the volatility and the mood swings, because nobody likes to see 30% corrections in their portfolio, but you always have to be prepared for those moments, because you can't even buy the S&P 500 and not presume at some point over a long period of time that it could retrace by 30 to even 50%. I mean, it's always a real likelihood that could happen at any time. So when I'm looking even at my triple leverage real estate ETF here, here, I mean, it's not even moving that bad. It's down 1.2% today. It's down less than the Qs are. The only thing you want to be real scared of is if you're triple leveraging like TQQQ here. I mean, this thing hasn't even been able to go back to all-time highs, and it's because it resets every day, and these things are scary to hold because, you know, you have to presume if you're buying anything triple leverage, which is crazy in the first place and something I have never really done, to be honest, you have to presume that if you get perpetually more red days or more severe red days than you do green days, because this resets every single day, yeah, you're going to be losing more than you're going to make. So I'm betting that when interest rate cuts start to happen, as it has happened in Canada, that this will start to outperform. I could be wrong. It's a very small bet. And thank God with these triple leveraged ETFs, the most I can lose is hopefully only my money. You know, if this thing has a 33% loss in one day, you know, times 3, I've lost 100% of my money. That's a real possibility, but it's a small leveraged bet on a very stable industry, or at least used to be stable since the pandemic. None of this shit's been stable. I mean, you zoom out on that long chart here, and it's 2020 has been the reckoning for real estate, and we've been through one hell of a volatile period. But like oil when it crashed, like many of these industries when they crash, I do presume there will be a rebound, and interest rate cuts likely to give it a rebound. We'll find out. Yeah, you know, it's all fugazi in the short term, but we'll see what the weighing machine does in the next year for these kind of real estate stocks. So when it comes to tech specifically, I've talked about this in my last video, you know, I'd be very, very cautious, but the deals are opening up if you're looking for sustained outperformance by buying these on an individual basis. And Google is, like I said, I have a love-hate relationship for Google because I love YouTube so greatly. And I feel like if they could sever YouTube, I'd buy it any day of the week. And they might be severing it. Who knows? It's still a real possibility. But Google has this problem of they're losing to other search platforms, right? What do I mean by losing? Like, they don't have to lose a lot. Sure, the revenue could still grow as people continue to expand on ad budget spending. But the fact is they don't share user growth on Google Ads and Google search. And I think Google search has peaked. I think thanks to Meta, thanks to, you know, Twitter or X's Grok, thanks to all these companies, Meta, I mean, they all have their own search bots at this point, and people are using them. My wife uses them. I use them. I know tons of people that instead of using Google search, and with, you know, the next upgrade cycle coming from iPhone here very soon, if they start, you know, if Apple starts kind of divesting itself from letting Google be the dominant search feature, they might start to focus more on AI search, right? And who owns that is the real question, because analysts reset Alphabet stock price target before key September court event. So the big problem here is this is going to be a landmark case. Like, Google has now been basically charged with monopolistic behavior, and what the consequences for that are unknown, because apparently, according to Bing or Yelp or whatever, they said when consumer conducts a Google search with a local intent, Google manipulates its results to promote its own local search offerings above those of its rivals, right? I don't know what's going to happen here, but, you know, regardless of the comparative poor quality of its own properties, right? So this is a really landmark thing that is going to highly debate on what happens to the future of this company. I think Google is worth more separated, but at the end of the day, like, they have everything to lose on search, and every other company has everything to gain, which is why I still fixate and why Meta is the largest kind of single stock holding in my wife's portfolio, and I'm still fine with it because Meta shows its user growth, and Meta knows that, hey, like, our entire platform is pivoted on user growth. Same you'd think with Google, but Google doesn't share it. They just don't share user growth on Google search. It's crazy to me. So I love Meta. Meta will still have a special place in my heart. A lot of people pick on Meta still. I don't know why. Yeah, the price to earnings multiples are getting very favorable, you know, probably more favorable with Google than Meta. But that's because there's adjusted risk going forward, right? So it'll be neat to see what happens. But honestly, what I think is going to happen is Google's going to probably post a blowout quarter this for the Q3. I think they all will. They've all been posting great growth quarters, and people are going to regain confidence, and the stock will likely shoot up another 20% or whatever. I mean, that's probably what's going to continue to happen until something materially impacts them from, you know, this lawsuit or something else. So when it comes to the broader S&P, again, you take a look today, right? Like, tech's continuing to sell off pretty dramatically, whereas the bottom half of the market is not selling off dramatically. So if you're concentrated in tech, you're feeling the pain, and I feel like you're going to continue to feel pain because Microsoft and Apple and these companies are still largely expensive for no reason until they can justify it. Can they hold up justification? I have a hard time believing it, because anytime Tesla gets way too overvalued, it corrects dramatically. Nvidia, same boat, right? Like, Nvidia's in a really perplexing, interesting place right now. But across the board right now, what my plans are moving forward have not changed. Like I said, guys, it's so overblown, it's so overdrawn, and if you just cost average into your favorite ETFs, you're probably not complaining as much today. Will I buy more triple leverage real estate? Yeah, maybe. I got some more cash on the sidelines. I'm looking at it. Like I said, I'm trying to fill out my interest rate recovery plays. I'm looking at XLU, super boring stock. I'm looking at, the triple leverage real estate plays, a shorter term play, because most of what I'm buying, I want to hold for the long term. I know I've said that a lot. For most of what I'm buying, I want to hold it for, probably my retirement. And so I can see myself holding XLU, which these utilities are great, VDY, SHD. I'm going to keep cost averaging into these, making them about 50% of my portfolio. And yeah, I'm just going to sit tight and see what the interest rate recovery looks like. And I feel like I'm poised to benefit greatly from it. But we'll see. Like I said, I'm going to keep building those out, and I'm placing my bets, as I'm sure you are, and I'd love to know where you're placing them. So let me know in that comment section below.